Hello and welcome to the Power of Passive Investing. We have a very interesting guest today. His name is Steve Gesis. Steve is a multifamily and other commercial real estate operator. He has a very long track record and he shared a couple of war stories with me before the interview, but we'll cover some of them during the interview as well. Steve, welcome.
Hi, Alina. Very nice to be on. Thank you so much.
Thank you. Thank you for joining us today. Steve, why don't we start with you sharing a little bit about yourself and how you've come to the point where you're at today?
Yeah, wonderful. Thanks. So, began actually in single family homes. We purchased our first single family home during the GFC. We built up 1,000 scattered site portfolio, built a property management company around that. And then we exited that in right around 2014, 2015. And at that point on, we looked at what the fallouts looked like, how we could maximize administrative capacities, how we could standardize processes. So we moved into multifamily, and we began with Class C, in Class D neighborhoods or Class C neighborhoods, value add, heavy value add, and we slowly grew from small multifamily to larger assets, mid-rise, 7-story, 100 plus properties, garden style. So also a garden variety of multifamily product, everything from patio style homes to, as I mentioned, garden. And so as we move through our trajectory and our historical life cycle, I've been involved in most of the operations at Smartland over the course of the last 15 years. I had an opportunity to be in throughout all of our departments. We're a fully integrated operator, and making us fully integrated, we're able to be hands-on throughout the entire life cycle of the asset. So we really are able to put the Smartland way throughout all the mechanisms that are required to operate a facility. And so that leads me up to kind of today. And so as we look at today and we look at the future, we're still expanding our portfolio, looking to purchase 100 plus multifamily throughout the Midwest, as well as the Sun Belt. We believe that there's still a lot of ample growth and opportunity for value add. And we're vintage agnostic. And so we're looking at really the opportunity, and various market cycles bring around a variety of opportunities. So we've had the opportunity to be through the GFC. We had gone through COVID. We've gone through extreme rate hikes. And so we've had a plethora of market conditions that we've operated through, and I think that's what has been my unique journey so far.
Awesome. Thank you so much for that introduction, Steve. I really appreciate you sharing that. And since you mentioned that you have a few ups and downs behind your belt, and you went through the financial crisis and then COVID and other things, how would you say this time it's different? Because obviously it's different every single time, but let's concentrate a little bit more on the current market shift, because that's what most of the investors are interested to hear about. How is it different from the other ones from your perspective?
Yes, very enlightening question. So this market cycle is different in a lot of ways because we have a compression in market flow, like deal flow. So we've had a downturn in deal availability. A lot of folks, I think, are waiting for the ball to drop, whether it's extended interest rates, banks to begin kind of unloading larger portfolios of troubled assets. Folks, in some cases, are waiting for execution on real opportunistic deals. And I think in today's marketplace, the story is really the headline when you're shopping for deals and or looking for deals, versus, let's say, last market cycle where there was an abundant amount of deals. Cash was much lighter in value, and so there was more deal transactions, more deal activity. So today you have to be a lot more stern. You have to be really, I believe, focused on what your buy box criteria is, and focus in that marketplace. Make the best of the relationships that you can between off market brokers, banks, and that's really different versus last market where folks were bringing you deals nonstop. Money was cheap, easily accessible. It was open season on it was open season on capital from a lot of sources, whether it was retail and or small institutional. So, it leads me back to kind of what we were talking about earlier. Money is kind of like Baskin Robbins, 31 flavors, and it does change market cycle to cycle. And
Mhm.
so understanding, who your target market is and who it is that you're looking for. And in today's market cycle, it seems like the older vintage, and I mentioned like we're vintage agnostic, but 1970s plus vintage multifamily is definitely the hardest product line to probably get some sort of financing for and or land equity on. 1990s, 2000 plus seems to be really the metric that a lot of small institutional and retail investors are hunting for, but they don't seem to be lending themselves readily available in the marketplace to purchase either.
Sure, and thank you for that perspective. Really appreciate you sharing how the markets have shifted and what specifically you and your team is doing to change your approach. In terms of the smart money, and you mentioned the 31 flavors, and I appreciate that. Kind of walk us through some of the flavors that are preferred on the market now, whether it's Baskin Robbins or beyond, and how are you guys accommodating those flavors?
Yeah, great question. So I think a lot of it has to do with, historically, as I mentioned, in the last market cycle, the money was a little bit more abundant, deal flow was a little bit more available. And so a lot of criteria was more agnostic, again, like the vintage and things of that nature. So for us, the story is the headline, and the story is the headline, at least in our case, because we believe that a certain category of smart money is still focused on the pure opportunity, right? So, like the deep loss, whether it was deep administrative issues, deep vacancies, really, really something where you can get, low 20s, mid 20 returns, but really, really have to have a great, compelling story, especially if it's sub 1990. Most of the smart money that we're interacting with seems to be looking at vintage it's 1990 or better. And again, a lot of that has to do not necessarily with the vintage itself or the core issues, but some of their experiences with the last market cycle and some of the operators that they had experienced. So some of the unforeseens, constant capital needs. Maybe in their prior investment they didn't allocate enough for capital expenditure on certain mechanical systems, and so some of those things as they come around today in today's demand, smarter money is looking at a little bit newer vintage. They're a little bit exhausted from the capital expenditures. However, as I said, there's still a very, very substantial slice of smart money that's focused on 1970s, 1980s vintage, understanding that there's a lot of value to have there.
Yeah, of course. Thank you. That makes perfect sense. Steve, you mentioned that you kind of had a natural progression going from single family to small multi and then to the larger properties and beyond multifamily in general. If you were to go back in that journey and give advice to someone who is just starting out, what would you say are some of the things that you would advise not to do, and like what kind of route would you choose if you were starting out again?
Wow. Well, no regrets in anything that we've done. And in fact, everything, as you said, has been a stepping stone journey. I think that, honestly, anybody that's just looking to start today, market prices are kind of heavy from an entry point. So it's tough to buy in on small single family and kind of start building out a portfolio because that market is just not there and readily available today. It's just going to take a lot more effort and money to raise a portfolio of single family homes. During the GFC, we saw a great depression on market prices then. So it was a great opportunity to buy and buy in bulk. And then figure out one of the things that didn't exist then was really commercial, like lending around scattered site. So figuring out that component was a big success story for us. Then moving on into multifamily, I think starting and getting really acclimated with what it takes from A to Z with a really, really distressed asset, and kind of learning every single component that's associated with a full value add, and kind of the operational needs of a multifamily asset. I think that's a great starting point for folks. It might be more than some folks are interested in chewing on. I was privileged to start with a few partners, and we were able to take multiple roles on, from property management to acquisitions to leading construction. And so our small team was able to really grow that onion over time. And I think the other really big takeaway is just to be patient. I think patience in real estate really means a lot. And what I mean by that is that my partner in passing had heard and shared with me a quote that he heard, and it was, the difference between a great deal and a good deal is 10 years. Uh,
Mm,
and
makes sense.
and looking back on things, it's definitely very true. You have to consider inflation, you have to consider all things. So in short, if I was starting today, I would again start with a duplex, learn everything about it, start with a small multifamily, move on to the next one, and slowly but surely build up a portfolio and a team. And then, I think being hands-on, and really knowing your product is the secret sauce.
I love it. I love it. And thank you for that. You mentioned that you had a good partners, good team, and I'm sure that helped to escalate the progress in general. For someone who is looking to build a team, what are your suggestions as to how do you find the right partners, the right team members to grow with?
So that's a personal question, I suppose. Not so much a technical question, but
Of course.
um, but you have to be risk. You you have to have the same level of risk. Be prepared to take the same level of risk together. You have to be prepared to understand uh, that your interests come last, and that
Sure.
you have to become and you have to have a team that really aligns with the focus and idea of being investor centric, investor focused, especially if you want to grow over time. And what that means is being highly transparent and forthright, not only with one another, but with the information that you're looking at and the information that you want to translate. And so, before we were able to venture into smaller institutional grade funding, a big primary portion of our business is also working with retail investors, whether they're using their self-directed IRA, or they're using, cash, or they're using some sort of inheritance, or any means of that. And we've had vehicles that we've developed that are both retail centric and both small institutional centric. And the one thing that's critical in both is and what's important for the team buildup is that you're realistic about what the expectations are, and that all expectations should be geared to being investor centric, and that means being very transparent. And as I said, with one another, and with your group of investors, and that's something special.
Of course.
Yes, that's something super special. And yeah, and actually let me add something. So at Smartland, what we do is, when we're onboarding and we're looking for a new hire, we have um, uh, we go through a series of intake for interviews. And one of it is, you have to take this like testing, and it kind of puts people in a profile. And so one of the things that we've identified is that my personal profile and my partner Vadim, who's the CEO, is that we're like black and white profiles. So we have completely contrasting. And so that's what's made that part of the relationship also very special, is that we're able to provide a variety of insights, from a few different angles. And then our partner Irina, Vadim's wife, she is our broker, in-house broker, and so she helps with operationally putting the property management team together as well.
Amazing, amazing. So, what I hear from you, Steven, correct me if I'm wrong, is all of the partners are bringing some sort of complementary skill set, and that what makes this partnership work so well, because each of you brings something valuable to the table and support each other from different angles instead
Oh
of
my gosh, you're so good at summarizing that. Yes, that was terrific. Yes.
excellent. Awesome. Thank you so much. Yeah, after doing several interviews and hearing people speak about different things, it becomes much easier to understand and summarize it. But anyway, great answers, by the way. I really appreciate your input on that. Steve, please share with us why multifamily. My understanding is you guys primarily focus on multifamily, not retail, not, I don't know, flex or industrial. It's strictly multifamily. Is that correct?
Yes, that's correct. Yep. We just wanted to be the best at what we do. It takes a really long time to get there. Uh, as I mentioned earlier on, rowing in the same direction and getting everybody's buy-in. So it's not just that takes over time. And so everything from training to developing the Smartland way throughout throughout every single process in the management side of it and the maintenance side of it. And so we just wanted to have a strict focus on one particular asset class where we can get very good at, develop the appropriate relationships, get scale at. And so we believe that multifamily is the ultimate product line for us that we got very good at managing and operating, understanding the real demands of value add and heavy value add, how to also execute the extremely complex ballet of modernizing units while folks live in the product, which is different from hospitality. You know, it's significantly different from self storage, where you don't have any mechanicals, you don't have any renters. But we believe that it's also, you know, one of the key ingredients to life is you have to have a roof, and at least here, and so one, it's a strong asset class for us. It's been a strong asset class historically. It's one that allows us to scale quickly, as I mentioned, and really brings together all of the specialties and kind of uh, just everything that our team is very good at doing from an organization standpoint, administratively, technology perspective. We're able to bring a lot of tech to the building. So for us, what we're looking at is that this is a kind of, in many cases, operations are pretty relic analog in many operations. And so being a younger, more technologically advanced operator, we have a distinct market advantage as we look into the next market cycle. Also, we're looking at permit starts. You know, there's been a fall off in permit starts. Housing demands still remain high in the U.S. And so multifamily for us is a very strong asset class.
I love it. Thank you for that, Steve. So, as one of the leaders of the company, what's your long-term vision? Where do you see Smartland going down the road?
For us, it's real simple. It's 5,000, 10,000, 15,000, and essentially ultimately moving into a REIT. So we believe that this new market cycle that we're kind of just right at the cusp of, as we sit here today, there's still a lot of pressure remains in the marketplace on a lot of operators from the previous market cycle. We've focused on really making our operation super agile and working to scale. And so today, as we sit here, we're looking to acquire more assets. And we do have a trajectory for that. We're looking throughout Ohio and Sunbelt, the Carolinas. Deals are available, just we haven't seen yet price points that we're comfortable in moving forward with. We are striking on a few deals, but not nearly the traction that we're looking to get. But we do believe that it is our pipeline is very healthy, so we do believe that we do have a lot of units that are going to be coming online here shortly.
So you guys are going to be very busy very soon.
We believe we're going to be very busy very soon.
Excellent, excellent. That's always good news. Steve, thank you for such great interview. We always ask two personal questions, everyone at the end. First one is how can our audience reach out to you? Where can they find you?
Oh my gosh, you can find us at www.smartland.com. That's SMARTLAND.com. You can always email me direct. I'm readily available, Steven.G@smartland.com. And yes, come visit us. You can visit our office in Ohio or visit our office in Miami. Where we love to meet, greet, have coffee, and share our experience. That's what really it's all about.
Where in Ohio is your office? Which
We're based out of Cleveland, Ohio.
excellent, good market. I like that market as well.
Good Midwest market has
Yeah,
been very strong to us, has been very kind to us.
excellent, excellent. And our last personal question is, how do you like to give back?
Well, I spend a lot of time giving back through kids' sports. That's one of the things that I do a lot. I volunteer as a coach in all of the youth sports around here. And then we just give back to the community through being very, very diligent about taking care of our assets, making sure that we are working with the community to really improve not only our community, but the general community. And we work with them in a variety of ways in giving back. And so we really have an opportunity to do that. And we hope that they'll keep growing. One of our key focuses is philanthropy. And so, anything that we can do to support, we're there for that.
Awesome. Steve, thank you so much. Thanks for the amazing interview. And for listeners, if you want to reach out to Steve or his team, it's very easy, smartland.com, or you can find Steve at steve@smartland.com. Thank you. And until next time, goodbye.
Thanks, guys. Bye bye. Thanks, Alina.